Hello Pathfinder community. Thank you for joining me for today's webinar. My name is Zachary and I'm a wealth advisor and certified financial planner with Pathfinder Wealth Consulting in Wilmington, North Carolina. Today I'm going to be talking about two topics, one that's been in the news for the past 12 months or so, and that's inflation, and another that has recently crept into the headlines, the dreaded word recession. I'll talk about the implications and the relationship between these two topics and where I think we are going from here. Let's talk about the agenda first. First, I'll talk about volatility in itself and investor behavior surrounding volatility. Then we'll talk about economic factors and some recession indicators to give us a pulse on where we're at today. And then we'll talk about some market factors that are impacting the stock market and could impact the market for the next several months, and then a summary of what we've talked about today. So first, talking about risk and volatility. This is a bit of a joke, but is the market or the economy the greatest risk to investors' portfolios, or are investors the greatest risk to investors' portfolios? I always tell clients that there are two primary ways that investors lose money in the stock market. Both of them are self-inflicted. The first is if someone invests all of their money in one stock or company. This is where the saying comes from, don't put all your eggs in one basket. Think about Enron or WorldCom, who went bankrupt during the tech bubble, or even companies like GE, who don't necessarily go bankrupt, but drop to a fraction of where they once were. The second way that people lose money in the stock market is panicking and selling during a downturn. This is far more common. This can happen if an investor gets into an investment not knowing the downside risk, and we've seen it time and time again. The saying is buy low, sell high, but most folks do the opposite. And it's no fault of their own, it's human nature. When everyone else is selling, naturally you have the urge to sell too. Think about if you were in a shopping mall and a group of people came by you running and screaming. Chances are you're not going to be asking many questions, you're just going to start running with them. With the stock market, that's the last thing you want to do in most cases. Of course, it's important to diversify and invest in things that have a greater chance of bouncing back when the turbulence subsides. Here's what we call the wall of worry. The point here is that there will always be events and turmoil that cause volatility and concerns in the world, the economy, or the markets. It's unavoidable. For the long-term investor, all of these items are just noise. It's important to focus on the long term and focus on your investment strategy and not make short-term emotional decisions. This chart goes back to 2017 and shows all of the major world economic and market events since then. Some caused minor and short-term pullbacks in the market, some larger, like the COVID-19 shutdowns. But over the course of time, the market has always come back. This is just a brief snapshot in time, but no matter what period of time you choose, despite the volatility, the market always tends to rise. One common thing we get is it time to take some cash out, sit on the sidelines, and wait until the volatility subsides? That sounds great in theory, and there are even investment strategies and subscription programs that claim that they can get you in and out at the right time, but that's false. We always say that an investor has a 50% chance of getting out of the market at the right time and a 50% chance of getting back in at the right time. Multiply 50% by 50% and you get 25%, which means that you have a 25% chance of timing the market effectively. And this chart shows that if an investor with the S&P 500 stock index, if an investor bought and held all the way from 1936 to now, what their cumulative return would be versus if they sold 10 months prior to a market peak and bought back in 10 months after the trough. And the results were much worse than if you were to just sit tight and hold on. This next chart shows the returns of the S&P 500 stock index going back to 1983, the gray bars. It also shows the biggest drop for each of those given years. 2020 is a great example. When COVID fears hit the market, the S&P 500 stock index swiftly dropped 33% from mid-February to the end of March. For investors who sold at the bottom, they locked in a really big loss. But for investors who thought they hit the jackpot by getting out of the market before the slide started, The market quickly rallied back and ended the year up over 16%. Back to my earlier comment, you don't lose money in the stock market unless you sell. So make sure you understand the downside of your investment strategy and be prepared to ride through when the bad times come. Another saying I have is that the market generally goes up 70% of the time and drops 30% of the time. And this chart illustrates that. This goes back to 1926 and counts 71 positive years since then and 25 negative years. For those who think they could time which are going to be the good years and the bad years, that's almost impossible. And again, back to the long-term investment strategy. In most cases, it's best to ride it through. Let's talk about some common terms that we talk about here in the office and what you might see in the headlines. So this is volatility primarily in terms of the stock market. So the first one is a market pullback. So a market pullback is defined by a drop in the markets of 5% or more. Typically occurs about 3 times per year. Next is a market correction. A market correction is defined by a drop in the market of 10% or more. This typically occurs about every 18 months or 1.5 years. Then there's a market crash. A market crash is when the market drops by 20% or more. This is often coincided with a recession and typically happens every 6 to 7 years. So you might say, well, where are we at today? So this is a snapshot of where some of the major market indices are year to date, as well as the biggest drop that they've experienced this year. Turn on CNBC anytime during the day, and the top 3 stock indices are what you'll see. These are generally referred to as the best broad stock market indicators for either the U.S. and domestic stocks. But look at the difference between these returns. The S&P 500 index is currently down 8.4% year to date, but it got to a point where it was down 13%. The NASDAQ, on the other hand, down 16, with the biggest drop 20.5. The Dow Jones, 4.9% year to date, with the maximum drawdown of 10% so far year to date. These are all domestic stocks in the U.S., but very different returns. The trends that we're seeing this year is that heavy tech, heavy growth companies are selling off more, as you can see with the NASDAQ index, whereas your value or dividend paying companies, aka the Dow Jones, has held up a little bit better. But the biggest story is really the bond index, which is shown at the bottom there. Bonds are typically referred to as a safe haven investment relative to stocks, and they've experienced a historical drop this year. In fact, bonds have never had a drop of this magnitude. The difference is that the bond volatility is not a result of stock market volatility. It's correlated to the expected increase in interest rates. As you may have heard, in an effort to aggressively fight inflation, the Fed has announced that they're going to have multiple rate hikes this year to try to get it under control. And simply put, when interest rates rise, bond prices drop. The idea is that if interest rates go up, existing bonds are less valuable because they are locked into lower interest rates than what can be found with new bonds. The good news is that higher interest rates mean higher yields for bonds over time, which will ultimately be good for bonds over the long run. But I will still say that bonds are a necessary part of most retirees' investment portfolio. Although it's important to know that they aren't a growth asset, they're an income asset. They're a necessary diversifier for a distribution portfolio. This year, more than ever, has shown that not only having a diversified mix of stocks and bonds is important, but also having a strategy for creating income for your portfolio during the good times and the bad. And if you're a client of ours, we do this for you automatically as part of your distribution strategy. All right, so let's get into some economic factors, some of which may push us or have the ability to push us into a recession. But first, let's talk about what a recession is. By definition, a recession is 2 negative quarters of gross domestic product, or GDP. This occurs about, as I mentioned before, about every 7 years. Well, what are the components of GDP? The biggest, by far, as you can see in the chart here, is consumer spending, making up almost 70% of the GDP number. The other 3, government spending, so stimulus, business investment, so private companies' investments in their businesses, and the last, net exports, which, as you can see, more recently has been a detractor from GDP. This chart goes back and shows GDP back to 2007. So I went back this far so we could see what GDP looked like during the 2007-2009 Great Recession. You can see there the few negative quarters of GDP, and then more recently you could see the COVID drop back in 2020, where we had two quick but very deep drops in GDP and a very quick recovery thanks to some of the stimulus. So as it looks right now, the expectation is that GDP will continue to rise, a lot of that falling on the backs of consumers as long as they continue to spend. And the question now is whether the reduction in stimulus will have an impact on spending, or if will inflation have an impact on spending if things get too expensive and consumers simply stop spending. So this is a list of risk indicators, 12 variables that have historically foreshadowed a recession. Right now, as you can see at the bottom of the chart, the overall signal is that we're still in an expansionary period. So that's good news. There are a couple that are either recessionary or cautionary right now, and we'll talk more about those over the next several slides. They are wage growth and money supply. Ironically, though, they were both at similar levels at the end of last year and haven't changed, at least for the first quarter, to any worse off stances. So wage growth is actually, in terms of a recessionary indicator, higher wages indicate, or stable to high wage growth is a recessionary indicator. So coming out, and I've got some charts that'll show this, but coming out of the Great Recession, wage growth was one of the most lagging things in the economy. Well, that has picked up, and I'll show you that in just a few minutes. Money supply is the amount of money floating around in the economy. A lot of it could be stimulus. So when there's easy money out there, when interest rates are low, or when the government's sending out stimulus checks, that puts a lot of money out into the economy with the idea that that is going to stimulate growth. So when that starts to stabilize, which it has recently, that's a cautionary or recessionary indicator. So right now it's in the cautionary mode because it's stabilized, and there have actually, as you likely heard in the news, there's been an effort to reduce some of the stimulus programs, stop the bond buying, which is called tapering, and some of those things. So we are watching that one as well. And then one that you may be thinking about that's not shown right now is a cautionary or recessionary indicator is the yield curve. So it is true that one of the spreads for yield curves has gone negative or went negative at the end of March. That is the spread between the 10-year Treasury and the 2-year Treasury. This indicator that they use here is the spread between 10-year Treasuries and 3-month Treasuries. And it is actually quite steep right now. So that's why this one's still showing an expansionary. We'll look at that a little bit further detail in the following slides. So just to give you an idea of what these indicators look like in prior recessions, this chart does a good job of that. So in most all historical cases, with one exception, all of the indicators, maybe one or two here or there, were either in recessionary or cautionary stance. The big exception is 2020. So 2020 only had a few of the indicators cautionary or recessionary, and I think that intensity and the quickness that COVID became a worldwide concern. It very quickly pushed us into a recession, and as we saw before, very quickly pulled us back out of it. Part of that was due to the stimulus, which arguably is the same stimulus that is a factor that's going into the high inflation rates that we're seeing right now. And in fact, it could, and we'll talk about this as well, but inflation, if not gotten under control, could push us into a recession. Again, as I mentioned before, if it gets so high that consumers stop spending. On the other end, if the Fed takes away the punch bowl too quickly, that could also hurt growth and push us into a recession on the other end. So there's a very fine line right now that the government and the Fed is straddling, and only time will tell if they get it right. So let's look at a few slides specifically with some of these indicators that are not expansionary. So as I mentioned, wage growth. This chart does a good job of showing wage growth coming out of the Great Recession, and it essentially flatlined until 2020, when big drop due to layoffs from the shutdown and with COVID concerns, and then a very quick increase again due to stimulus, the PPP programs, where wage growth shot up, and it has stabilized since then and remained at a higher level than it has historically. So that's the reason right there that indicator is less than expansionary, because of higher wage growth that we've seen recently. But is that a concern? Here's a couple different indicators. We've got the average weekly payrolls, which is wage growth, and we have personal consumption expenditures and CPI, which is the inflation rate. So consumption obviously is closely tied to changes in income, and so far they've run ahead of inflation in recent years. So this is good news. This means that the wage growth is keeping up with inflation so far, and means that maybe it's not high enough with the higher incomes that folks are getting to be able to push us into a recession. Next is the money supply. So this goes back to early 2020, when the massive stimulus was released as a response to the pandemic. This has stabilized recently, dropped a little bit, not a whole lot, but has stabilized. And as that starts to go back the other way, that's where this indicator starts getting a little more recessionary. And that's self-explanatory. If you take money away from the consumer, they're not going to spend as much. You put money in their pockets, they're going to spend. And there's a saying, don't fight the U.S. consumer. If you put money in their pockets, they're going to spend it, and that has historically gotten us through bad periods when GDP is suffering. So next we'll look at the yield curve a little bit. And this first one is the preferred measure for this tool, which is the 10-year Treasury spread versus the 3-month Treasury. This is where the yield curve is quite steep. So this, going back in history, you can see when the blue line dips below the black line, that's when the yield curve is inverted. And that has been a pretty foolproof indicator of entering a recession. Here you can see, going back to the 60s, every single time the yield curve went negative, there was a recession following. And you can see that with the shaded gray part of the chart. Even 2020, just prior to COVID, there was a brief period where the yield curve went negative in this measure. So far this year, again, with this spread between the 10-year and the 3-month, there has not been a yield curve inversion, and it's actually quite steep, which is indicating below average recession risk. This next one, this is what you're hearing in the news. So this is also looked at as a recession indicator. You could see it back in time of how every time it went inverted, there was a recession followed. It did go negative on March 31st, which indicates higher recession risk. So, which one do we look at? Different economists look at different indicators, but that is a negative sign. Really just historically looking at this indicator and how really foolproof it's been in being able to predict or forecast a recession. All right, so next is inflation. So inflation, obviously a big topic in the news today. Inflation is at a 4-decade high right now, and there's an argument of what's causing inflation. Is it all COVID related, labor shortages, manufacturing shutdowns, supply chain issues, or is it a result of the stimulus and putting too much money out there into the economy, which naturally, when there's that supply-demand imbalance, that's going to push prices up. So most of the inflation that we've seen pre- and post-pandemic is coming from goods. Used vehicles is a good example of that, and that's how this is broken down in the chart here. So prior to the pandemic, goods were not a big part of inflation, or goods inflation was not a big part of price increases. Since then, it very much has, as with used vehicles. So that's interesting that has continued to increase at those levels, despite what everyone was saying initially was that once these supply chain shortages get worked out and once the manufacturing facilities get back online, inflation would quickly drop. Well, it just hasn't. It has continued to increase, and maybe fueled the fire a little bit from the Russia-Ukraine situation with energy prices and some other commodities, causing more continued increase in inflation. And time will tell. Again, this is what the Fed is fighting right now. Try to get this under control before it starts to have an impact on the U.S. consumer. This also shows the inflation of goods, services, and the core CPI. So the bottom line, the blue, again illustrates that the 2 decades prior to the pandemic, there was really no goods inflation in the U.S., and that has had a big spike coming out of the pandemic, and that's causing a lot of, again, what has caused the inflation increases. So will that get under control? Time will tell, but the Fed is doing their part right now in trying to increase interest rates and pull back stimulus to try and get this number under control. I think naturally it will. The year-over-year measure that they use for the inflation readings, once the prior year number starts hitting the higher numbers that we started to see last year, that naturally should bring the inflation numbers down over time. So I do think it'll come down. It's a matter of how quickly it will come down and how low it will drop back down to whether it still can potentially impact the U.S. consumer. Energy is one of the areas that has really impacted the consumer, and it's one of the most largely talked about pieces of the high inflation, and we've seen it at the pump. The Russia-Ukraine issue has made that even more, even closer lens on higher energy prices. But this is an encouraging slide. This shows the percentage of personal consumption that goes towards energy, the U.S. consumer. So looking back to 2011, 2014, when the oil prices were similar, at that time, incomes were a lot lower. So energy was actually a higher fraction of consumers' budgets. So the current increase, really looking at these numbers, has been in line with the wage growth that we showed earlier. So right now it's saying that the oil prices are high, yes, but there's enough income out there and enough money in the economy from the U.S. consumer standpoint to be able to cover those higher costs of energy. All right, so let's shift gears a little bit, and we're going to talk about some market factors. So previous, mainly talking about the economy and economic factors. We're going to talk about the market a little more detail to talk about how the market can be impacted by some of these factors and what we're seeing out there today. So first of all, this chart shows how the market typically reacts 3 months before and after the first rate hike. So it's not uncommon for the markets to react negatively when there's an announcement that the Fed is going to start tightening the policy. We saw at the beginning of this year, January, the first week of January, when the Fed came out and said they're going to start being more aggressive about getting inflation under control, and one of the main factors that they'll use, or one of the main levers they'll pull, is increasing interest rates. And that's what started the slide in the markets back in January. This was before Russia-Ukraine started to be an issue. And you can see back in 2015, by looking at this chart, there was a similar drop of about 13% in the S&P 500 due to the announcement of that rate hike. Looking forward, however, once that initial rate hike happens, historically, the markets perform positively. And this shows different asset classes and how they've increased following the initial rate hike. And some of the areas that have been hurt more and that's growth stocks, so NASDAQ companies, tech companies, mid-cap companies, and international companies typically do well once the rate hiking cycle is underway. So this is positive news. This shows that that initial reaction is often oversold, and the market will typically recover after those rate hikes start. Another factor we're dealing with this year, which hasn't been talked about a whole lot in the news and in the media, we see it driving down the street when we see the political campaign signs, but it's a midterm election year. So historically, they're just choppier years that are plagued with more volatility. So this chart in particular shows the average correction and the yearly correction for each midterm election year, as well as the average recovery. So the most recent, there was a 20% drop in 2018. The recovery was 37%. So again, this is noise. This is short-term volatility. You should not be making investment decisions based on election results. There's just not very much correlation between political party and market returns. And although it may cause more volatility and some pockets of volatility, those will recover, and they always have. All right, so that wraps up the majority of the presentation here. Just want to go over a few high points and summarize what we talked about today, both on the economic picture within the U.S. and the market outlook within the U.S. So first, right now, recession risks are low. We'll continue to watch those indicators to see if any of those turn sour, but right now, pretty good picture within the U.S. Next is the yield curve. So the 10-year over the 3-year has steepened, which indicates continued economic expansion, but there was the 10-year, 2-year spread that went negative, so we'll be watching that to see if that has potentially has future implications on the U.S. economy. And we're still coming out of the pandemic, so there's still a recovery there that needs to happen. So the economy should continue to strengthen, helping to negate the impact of higher energy prices, and we should see that continue. Consumer headwinds versus tailwinds. So there's more tailwinds that are pushing the consumer forward than there are headwinds. So that's positive. That means that there's more spending money out there with higher wages. Household savings rates are still good. So there's a lot that working in the case of the U.S. consumer. Aside from higher inflation, but so far that just hasn't been an impact. Next, looking at the U.S. market outlook. So, typically it's very typical for some choppiness and some volatility whenever there's a transition from a very easy money policy and a very accommodative policy to a tightening by reducing the stimulus, stopping bond purchases, and increasing interest rates. So. But historically, that has been more short-term, and we've seen a market recovery from there. There are a lot of headwinds out there. As I just mentioned, the tightening monetary policy, the elections, negative fiscal impulse, the geopolitical situation overseas, and, of course, high inflation. So there are a lot of factors at play. From our perspective right now, those are short-term issues and are noise for the long-term investor. And simply put, any volatility or any correction that we've seen in the markets, we've used as rebalancing opportunities for our clients' portfolios. So there have been, as we saw with the major stock indices, there's been a lot of differences in returns for various asset classes, and that's a fantastic time to go in there and rebalance the portfolio, buy into areas that are out of favor, take some profits where there are profits. As we always say, it really comes down to your financial plan and your individual risk profile and doing what works for you. So if you're a distribution client, making sure that you've got a solid distribution plan and a distribution strategy. If you're an accumulator, use these dips as times to put more money to work if you've got cash on the sidelines. Thank you for joining us today. I appreciate you taking the time to listen. As always, if you have any questions or concerns, feel free to shoot me an email, john@pathfinderwc.com, or give us a call at the office, 910-793-0616. Thank you and take care.